I would like to focus on the first of several topical questions in Europe today. How real is the real side recovery? Let's start with a classic indicator of future prospects, share prices. Recently, there has been an impressive recovery in European stocks, in line with what has happened in the United States. But these are still modest from a historical perspective. The same is true of sovereign risk. While we cannot rewind all the way back to the pre-crisis, when there was not enough risk differentiation, there is still room for improvement in spreads. The financial rally is not just a matter of Europeans feeling better. Non-euro area foreign investors, too, have decided to shift from safe havens like Germany back to Spain and Italy. Underlying the better financial mood is a clear strengthening of high-frequency indicators such as PMI across the whole euro area. An important development in Europe is that domestic demand has turned positive for the first time in almost 2 years. Looking forward too, we can expect a boost from fading fiscal drag. But there is another side that has limited upward revision in our recent World Economic Update. One factor is the drag on consumption and investment from balance sheet overhangs. The other is the fact that investment remains depressed across the entire euro area. Nor is the contraction in bank credit helping. Historically, creditless recoveries have yielded weaker investment and GDP growth. Not surprising in a bank-centric system like the European economies. An underlying force is financial fragmentation. Euro area corporate lending may have fallen on average, but the dispersion around that falling average is much higher. The problem is acute for SMEs whose loan requests are being rejected at higher rates. These facts put a question mark over growth and employment prospects, given the key role of the SMEs in the European economies. So what kind of growth is required to dent unemployment? Here, we have looked at previous episodes of continuous decline in unemployment for over 10 years and see what kind of growth these economies have had to achieve that degree of decline in unemployment. And here are the growth rates. As you see, these are much higher than growth rates that are currently being projected for growth moving forward. I also want to draw your attention to the negative relationship between unemployment and investment. There has been a negative relationship even prior to the crisis. It has continued during the crisis and since the crisis. With this, potential growth in Europe has declined from about 2% to almost 0.5% now. This does not bode well for the future, as employment declines and declines in capital mean that potential output in Europe is lower. In short, the economic recovery in Europe is real, but the pace of recovery is weak. The question is, what can policymakers do to improve the pace of recovery? First, policies need to remain supportive of growth. For instance, while monetary policy has done a lot to support the recovery, it may need to do even more as we move forward. Second, potential growth needs to improve in Europe, and the answer to that is structural reforms.